Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance covering investments, insurance, loans, real estate, and everything else about your money. We, of course, would love to hear from you. So if you have any questions or queries, please feel free to write in on this YouTube Live. I'm Samina Nalwala, your host for the evening. So let's start with the top stories of the day. First up, India's new GST amnesty scheme will start on November 1st, 2024 to help taxpayers of unpaid GST demands from the years 2017-18 to 2019-2020. Under the scheme, interest and penalties will be waived for cases that are not fraudulent. And the biggest story of our times, India's largest IPO, Hyundai Motors, opened today and will close on 17th October. Before the IPO closed, the investors, of course, managed to raise through the anchor book 8,315 crores through 225 anchor investors. The company's performance in the unlisted market has been slowing down over the last couple of weeks, with the grey market premium now down to 45 rupees per share, indicating a potential listing gain of 2.5% to 3%. According to experts, the falling grey market premium is due to concerns over valuation and the fact that the subscription is priced to perfection as compared to its peers Maruti and M&M. Well, the other big story is a good set of earnings from HCL Tech. HCL Tech reported numbers that beat street expectations on all fronts. There was a call from Jefferies, which maintained its whole call on the stock with a target price of 1770. Nomura as well maintains a buy call on the counter with a target price of 2,000 rupees. On one hand, you had HCL Tech, which impressed the street. On the other hand, it was Reliance Industries, whose earnings missed street expectations. Despite that, Jefferies maintains a buy call on RIL with a target of 3,400 rupees a share, while Nomura has a target price of 3,450 rupees a share. The brokerage also added that RIL's long-term outlook, despite the subdued quarter, continued to remain promising. Well, those were, of course, the top headlines that we have. Along with that, the other quick update is on the Adani Group, where the promoters have reduced their pledged shares in 3 of its listed companies: Adani Energy Solutions, Adani Green Energy, and Adani Ports, and SEZ during the September quarter. This, of course, a big positive for the group companies. In other news, we also believe WhiteOak Capital Mutual Fund has launched its new fund offer for the WhiteOak Capital ESG Best in Class Strategy Fund. A new ESG fund is to be launched over 3 years. This NFO, which will open, will also close on the 25th of October 2024. The fund aims to invest the proceeds in companies with strong corporate governance practices and seeks to generate returns by focusing on high-quality businesses that show long-term sustainability, scalability, strong execution, and a commitment to superior corporate governance. Are you interested in investing in this new fund, which is ESG friendly? Well, those, of course, are the top headlines that we are tracking this Tuesday evening. But let's go across now to a special guest joining us on the show. We have with us Sunil Jhaveri, founder and chairman of MSJ MisterBond, to talk to us about whether or not debt looks like a good allocation to make for retail investors. Thank you, Sunil, for taking out the time to talk to us this evening. I wanted to have a sort of candid conversation which revolves around debt. You know, we so often talk about the role of equities, the role of mutual funds, investing for the long term to create wealth. Very rarely do we talk about the role of debt in a portfolio. So I want to start by asking you, Sunil, first up, what is the importance of asset allocation at a portfolio level? Often we talk about rebalancing funds at a product level. But I think more important than that is for investors to have their asset allocation correct at the portfolio level. Do you agree?
Absolutely. Thank you, Samina, for inviting me on the show. I was surprised that you're doing a show on debt rather than equity, which is the hot topic currently. But yes, at the
equity is always hot, Sunil. We've got to find a spot for that.
I hope it remains hot for more time to come, in the near foreseeable future also. So coming to your question on whether one should do asset allocation at the portfolio level, yes, I believe that it should be done at the portfolio level, because people invest. Investors have their biases. So somebody will be equity heavy and they only believe that equity can create wealth for themselves, or somebody may not have. They have total risk aversion, so they may not have any equity in their portfolios, and they may be debt heavy. So these are the personal biases which gravitate towards either equity or debt. But the right and correct mix of portfolio between debt and equity is based on the valuation of the markets. And that's the reason why debt can play an important role at the current juncture when the markets are expensive and going towards the euphoric zones also.
Or and for long-term wealth creation, allocation needs to be made to both instruments. One for capital protection in some cases, and the other for capital increasing or capital creation in that sense. So let's start with recommendations, right? For an individual who has an average risk profile, so willing to take on some risk, but is looking to create wealth as opposed to just sustain the current level of wealth or beat inflation, what do you think is the average asset allocation he should be aiming to achieve at a portfolio level?
Of course, it's very individual based, strategy in terms of asset allocation. It is dependent on the age profile of the investor also. But having said that, the investment industry talks about 100 minus your age as your equity allocation. But I believe that equity allocation should be based on the valuations of the markets. You can take valuation metrics as price to earning, price to book, dividend yield, or a combination of any one or two of these metrics, and then do proper asset allocation and rebalance between debt and equity through the proper mix, and that is the correct portfolio asset allocation as far as the investors are concerned on a risk adjusted basis. If you go 100% into equity at any valuation, naturally you will have hiccups going forward if the valuations at which you invested in equity was at an expensive zone. So just to give you an example, if somebody would have invested in January 2008, and we say long term is 3 to 5 years, Jan 2008 to now, it's almost 16, 17 years. The markets have delivered only 8.5, 9%. I'm talking of Nifty 50 returns. Why is that so? Because the markets were extremely expensive in Jan 2008, where price to earning was 29 and price to book was 6.5, and we've not touched those levels ever since those days to now.
Right. Okay, let's break this down, right? So then, like you said, firstly, I think most of us use the word debt very loosely. But just before I go into breaking it down at a product level and the various instruments that are available, in your opinion, what is the role of debt in a portfolio? Is it largely to do with protecting the downside and providing that much needed cushion that a portfolio may require in times when the markets, the equity markets, could turn tough?
Sure. So there are three ways you can look at debt. First of all, debt should be part and parcel of anybody's portfolio for emergency cash. That's number one. So it
Okay.
can be 6
Okay.
to 12 months of your expenses, which you may think is what may be required. So that is your debt component. It can be parked in liquid fund, fixed deposits, etc., whichever ways, or savings bank account also. The second important role a debt plays is, as you rightly said, it cushions the volatility. If the markets are expensive and you switch from equity to debt, it becomes a temporary parking vehicle. So it's a cushioning effect if the markets become volatile and markets go in a tailspin in terms of the correction side. So it acts as a cushion, and it acts as a temporary parking vehicle in the debt product till we reinvest it back into equity at better and better valuations. So these are the three main important aspects as far as debt is concerned.
Hmm. Uh, Sunil, let's tell our viewers the different types of debt products. Now, of course, with the recent financialization of assets that everyone is talking about, and banks especially have been complaining about it, the one very deposits. So whenever anybody thinks about debt, they think about fixed deposits. They're pretty much interchangeable in that sense, right? But there is so much more available in terms of debt products. You have debt mutual funds, you have short-term debt, medium-term debt, long-term debt. You can invest in credit, you can invest in duration, and the list is extensive. You can buy government of India bonds, you can buy corporate bonds. You want to simplify this gamut and universe of bonds for us and what really is debt, because I do know it goes beyond just simple fixed deposits.
Yeah, sure. So there are different instruments and vehicles through which the investor invests in. Practically everybody would be having some component of debt in their portfolios. It can be tax-free bonds, it can be fixed deposits, it can be PPF, or it can be investments in the mutual fund space also, or it can be NCDs or fixed deposits of a corporate. So these are different types of debts, and each one will have their own unique risks attached to each one of them. Of course, we'll talk about the risks a little later, but these are the different products, debt products, which will be available as far as the investor is concerned, from where they should be selecting or investing.
Is Sunil, is one product more efficient than the other, or more preferred than the other? For some people, and maybe because of taxation and the way inflation has been moving and the sort of fixed deposit rates that one can get today, FDs have ideal safe haven asset, right? In your opinion, with everything that you see on a platter, what do you prefer or what do you recommend really?
Frankly speaking, people don't need to invest separately into debt. As I said, they already have some allocations either through PPF or fixed deposits, or in the mutual fund space, they may have invested in equity saving fund or a balance advantage fund. Each category will have some portion of debt. But that tax arbitrage of debt, investing in debt directly versus investing in debt through mutual fund, is no longer there since March 2023. So there is no differentiation whether you invest in debt directly in a bank deposit or a tax-free. Sorry, tax-free bonds are already tax-free, but investing directly or investing through a mutual fund. Earlier, there used to be tax advantage of indexation benefit, long-term gains tax, short-term gains tax, etc. All that is done away with. We are at par as far as bank deposits versus the investing in mutual funds are concerned. So there is no tax advantage as such.
At a portfolio level, which also means that the allocation you make to debt should be dependent on your risk profile. But what I want to ask you today is with this impending rate cut, with everyone talking about how the Fed has cut rates and the RBI will do so in a few months, suddenly the investment conversations revolve around should you invest in debt mutual funds? So, this is my question. Should you invest in debt funds for tactical allocation to take advantage of a rate cycle? And of
So,
course, is the current rate cycle a good time to build that allocation if you haven't already?
sure. So see, the rate cycle, we are at the interest rates which have peaked off, and from here on it can only soften from going forward. But having said that, debt is a very misunderstood product and an asset class. Not maybe many people understand debt. There are various risks attached to it. The most important risk, which is interest rate risk or the credit risk, is many investors don't understand that. They come from that background and the mindset that fixed deposits are giving me regular income. It is absolutely safe in terms of safety of principal, etc. All that goes away once you start investing in debt through a mutual fund space. So unless and until you understand the nuances of the debt markets, long-term, short-term debt, Macaulay, the modified duration, the yield to maturity. So it's a very complicated process as far as retail investors are concerned to understand debt. So better is that if they wish to be in debt, they should be either in a liquid fund kind of a product or a low duration kind of a product, or arbitrage funds is an alternate to a debt which is 100% hedged, if they don't wish to be in a bank deposit or a savings bank or a recurring deposit.
So, Sunil, is it fair for me to assume then you are advising investors who have little knowledge about this asset class to use debt only as a parking instrument and not to look at it as an opportunity to generate or create alpha?
Opportunity for to generate create alpha is there with the smarter investors or the institutional
Okay.
players who will understand the interest rate cycle. There are many loose cannons as far as debt markets are concerned, the same way in equity markets also. They are dependent. The interest rate cycle is dependent on global factors, the current account deficit, the fiscal deficit of the country, the interest rate, the inflation. So all these are very complicated subjects for people to understand which way the markets are going to be headed as far as debt is concerned. Now we are assuming that the interest rates will soften going forward because inflation is under control in India and the central banks across the globe have started cutting rates. We expect that India also might cut rates. But because of the geopolitical issues, the crude can go off in a different tangent
Yeah,
altogether. Thanks to
yeah,
that, the current account deficit, the imports of crude and the gold, which will have imported inflation as far as India is concerned, the erratic monsoon and the impact on the food inflation. So all these are, too many loose factors for people to
yeah,
understand
yeah.
which way the interest rates will be headed.
Right. Sunil, and you're so right, right? This is a complicated universe, but I think it's actually very important for individuals to understand this asset class because there is so much to offer. But I know one product that's very popular amongst retail investors and actually outperformed the benchmark historically has been hybrid funds. Now, hybrids funds, by the name suggest, is already doing asset allocation for an investor, right, who doesn't have the know-how of asset allocation. What are your thoughts? What do you think about hybrid funds? Do you recommend it?
Yeah, sure. So hybrid funds is where you will add some flavors of equity. So there will be equity saving fund to start with,
Uh,
which will be 20-25% in equity. Then there will be balanced advantage fund kind of category, which will move equity from 30% minimum to 100% in equity if the market valuations are cheap. Or there can be arbitrage funds, which are also treated as part of hybrid funds only, which are 100% hedged. There will be no market directional call. But whenever you involve equity as an asset class, you cannot compare that with a pure debt product.
Yeah. Also, how does taxation work in this asset class?
No differentiation in whatsoever anymore going forward, because from March 2023 onwards, everything in debt, be it you invest through a mutual fund product or you invest directly, so fixed deposits, what is the marginal slab rate which you are paying on your fixed deposit rates, interest rates, the same thing will be applicable as far as the debt in the mutual fund space is
Questions,
also
good.
concerned. So let's assume you have a short-term gains tax or a long-term gains tax. There is no differentiation of long-term or short-term. Everything will be treated and taxed as the marginal slab rate.
Well, that's interesting, Sunil. And I think this wraps it up, right? Because while this is a very important asset class, like we've explained to you, but like Sunil said, if you don't understand it well enough, use it only as a parking instrument. And when we say parking instrument, what we mean to say is that instead of having your money in a savings account, waiting for the dip in the market to invest that money, use that money, put it in a liquid fund. It's far more efficient in terms of returns. And remember, they say boon boon se sagar banta hai. So even if those returns are small today, over the long term, managing your money efficiently is always going to be beneficial for your portfolio. But I have a few queries, Sunil, this evening, which I'd quickly want to take up with you before we actually wrap up this edition of the show.
Now,
Nidhi Singh writes in, and she says, are there any hidden charges or fees in debt funds that retail investors should be aware of? How do they affect the overall return? Such an important and appropriate question, because not too many investors even know the kind of fees they pay when they buy or invest in a product. What they need to be told first up is that there is no free lunch in this world.
absolutely, there are no free lunches. When your money is getting managed by somebody, which is the asset management company.
Always get
They
questions.
invest. There will be some transaction costs while when they buy and sell those debt products or debt instruments. Plus, there will be some management fees, custody fees, etc., custodian fees of keeping that those securities in place, safe at a safe place. All these are the expenses which will be charged to your debt product also, debt mutual fund schemes also. But what you are seeing in terms of the point-to-point returns is basically post those expenses. So it should not bother you, because finally debt as any asset class, be it debt, hybrid or equity, will have some management fees, custodial fees, and transaction costs also. But they
And
are all
those are
inbuilt.
largely similar.
These are
They are
all inbuilt in the
similar
debt
or
asset class.
lower than
What you
equity.
are seeing- Sorry.
Right. Sunil, these are largely similar to equity funds, or are they lower than equity funds?
They will definitely be lower expenses than the equity funds.
And any lock-ins, any penalties if you do premature withdrawals?
Of course, so there will be some exit loads in place. So let's assume there is a 3-year product, and there might be a 3-year exit load in case the fund manager thinks that they don't want to have hot money which can go in and out and affect the returns of the other investors. So there will be exit loads in place even in liquid funds. So there can be a liquid fund which will have a 7-day exit load. So after 7 days are over, then there is no exit loads in those schemes.
Right. The next question we have, Sunil, is from an investor or a viewer called Vineet Patel. And I do understand from his question that he seems to be a savvy investor. His question is, how should a retail investor choose the right type of debt funds? Should it be, how does one determine whether they should put the money in a liquid fund, a corporate fund, and even gilt funds? So maybe you want to start by telling our viewers what are gilt funds, what is the risk one carries, and maybe determine that or break that up depending on the time horizon. Sunil, you want to elaborate?
Sure. It's very difficult to explain in a very short, brief conversation like this. But the longer the duration of that fund, so let's assume that the fund manager invests in a 10-year GSEC fund versus a fund manager investing in a 1 to 3-year short-term bond products. Naturally, the gilt fund, which will have more volatility because of the modified duration, which is on the higher side, versus a 1 to 3-year product, which will have lower volatility because of the modified duration being on the lower side. So if you are looking at less volatility and maybe a little higher yield, you may wish to get into a credit risk space. But again, one needs to be very careful in terms of understanding that there will be a credit issue also. But since you are investing through a mutual fund product, the credit risk gets spread across many issuers.
Right, Sunil, I'm going to throw a curveball at you. If somebody is looking at an instrument, and let's do this as a quick rapid fire, right? If you're looking at an instrument to park your money under 30 days, what should they look at?
Liquid fund.
3 months?
Low duration fund.
6 months?
You can get into arbitrage funds.
Even though that's not equity. I mean, that's not debt.
That is not. It's 100% hedge.
It's a quasi debt. Yeah.
No,
So
it's not quasi. It's basically you're locking in your returns on day one of your investment. So what it does is they're buying cash and selling future. It's the arbitrage of equity differentials.
But the underlying instrument is an equity, right?
100% equity, but they cannot go negative. They disinvest on the last FNO settlement date, which is the last Thursday of every
month. So under 1 month, we like liquid, 1 to 3 months, ultra short, 3 to 6 months is arbitrage. I'm going to go 6 months to 12 months quickly.
No, ideally, as 1 year plus is arbitrage, because 1 year plus arbitrage will have equity taxation. Arbitrage has an equity taxation. So from 3 months to 12 months, you can get into a low duration kind of a product.
And beyond 1 to 3 years, if you're looking at 1 to 3 years?
There are short-term bond funds, but there will be no tax advantage.
There are no, that's fine. But even just in order to tactically allocate money for a 1 to 3 year period, you think short-term debt funds look good. And at this juncture, yes or no into 1 to 3 year duration funds?
Yes.
Okay, so that's, I guess, explains that all to our viewers. If you are a hardcore equity investor who's waiting for the dip in the markets to go out and allocate, please be wise. Don't keep the money sitting in cash. It's never a good idea. You want to park it in liquid. Remember, you can very simply do an STP, which is a systematic transfer plan, or you can do a withdrawal and then move it to equities. If you're looking at a duration of holding or parking your money, so if you've got money parked aside to go on holiday in the next 3 months, maybe you want to look at an ultra short duration fund. And of course, if you're planning the summer or you're planning a children's school fees, which would be next year, maybe parking that money in an arbitrage fund wouldn't be such a bad idea. We've tried to cover a little bit about debt. Hope we've done a good job, but please write in with your questions and queries. We'd be happy to take them on over the course of the next few days. Thank you, Sunil. Great having you on the show.
Thank you for inviting me, Sabina. Always a pleasure.
Okay. Likewise. Thank you very much.